Good evening, everyone. So welcome to the third live session of corporate finance. So I hope IAs are going on good on the basis of async material. Pranja, I don't have to press the recording. It's already done, right, from your end? Yes, how are the IAs going on? No. How are the IAs going on? No response I've got. Is it good? Should I take silence as going on good? Okay. So today the topic of discussion is going to be on first, continue with time value of money. But today we are going to look at the multiple cases where one is the loan amortization that we did last time in the form of Excel as well. I hope the Excel sheet has been shared with you all. The completed Excel sheet, have you all received it? The one that we were discussing in the class? The loan amortization schedule that we discussed in the class last time on Monday. We haven't checked. No response. I don't know. Are you all there? No, I have already shared the recent one, the one that we worked on Monday. I'm talking about that. Isn't it uploaded? Because I've already shared with the, okay, I've already shared with the coordinator. Anyways, I would again remind the coordinator to share it with you all. I had already shared it on Tuesday morning, but anyways, I'll remind again. Okay, so the same loan amortization, because the topic of discussion today is the multiple cash flows. The topic of discussion today is the multiple cash flows. That is when you are making multiple times investment, whether it is your pension plan where you make regular investments, that is your ULIP, your SIP plan where you make continuous investment, what would be the future value of the investment? Or when you take up a loan today, how much is the EMI that you pay on the loan? So there's the annuity or the multiple cash flows that we are going to look at in today's discussion. Now, coming to this, the loan amortization schedule, what was the concept here? What is the concept here? So you, in your async material, you have gone through something like this. If you remember, my present value is equal to future value annuity into 1 plus r raised to n minus 1. Have you gone something like this? And the whole is divided by r into 1 plus r raised to n. Have you gone something like this? Gone through this? Right? Where is the application part of it? Where do I use this? Now just imagine the loan amortization schedule when you're preparing it. Can I say my FVA is the EMI that we pay on the loan? FVA is the EMI that you pay on the loan. Yeah. And The other term is where you're paying your EMI every month. What is the amount of loan that you can avail today? We can do work on this two ways. One is some of us may know our capability to make the EMI payment. So I know that every month I would be able to pay an EMI of 75,000 rupees. Then I can work backwards and see what could be the loan amount that I can take from the market today. Or it could also be based on that my requirement for loan is known for me, that I need 10 lakhs of rupees. And then I work back and see that how much is the loan or EMI that I have to pay on a monthly or a yearly basis, whatever. This is now the same thing what we did in Excel on that day. The same thing if you want to do it using a calculator, then the link I have shared in the PPT today that you can see here is the, allow me a moment. Yeah, loan amortization calculator. So whatever is the loan amount, say for example, if I'm taking up a loan of 10 lakhs, right? And if I want to take this loan for 20 years and rate of interest in the market is, say, for example, 7%. I can come to know the entire schedule that we had created on that day. Remember this schedule you've forgotten. So should I open up and remind you? Should I show you that sheet that we did on that day? Yes, I'll do that. Give me a moment. Yeah, this is the sheet. Remember this? We had done this on that day. The same thing, we calculated it here using the function PMT, PPMT, IPMT. The same thing, instead of using Excel, if straight away I want to do the calculations, I can do this using the calculator, where you get your beginning balance, that is the loan amount that you have taken. You want the monthly schedule, you get the monthly EMI payments for every year, interest, principal, and the ending balance. This I wanted to share it with you for the reason that if you have your current any loan, you will be able to put the values and see yourself that how is the interest and principal amount, the EMI that you're paying to the bank, how is the interest and the principal amount that you can see for yourself, right? Now, there's something called the present value of a perpetual annuity. Now, this was also earthing material you have seen, but this, when I was correcting your IA2 paper, I found many of you had done this mistake. How is it this formula is, we want to say, I'll give you example, okay? What is the amount when I become 60? What is the amount I should be investing so that I can get an equal amount in the future value annuity divided by the rate of interest? Where is the application of it? So when I turn 60 and I invest, say, what is that lump sum amount that I should be investing so that I can earn 12 lakhs per annum? Now tell me, what is the amount I should invest today so that I can get 12 lakhs per annum? Say, for example, if the rate of interest in the market being offered on this instrument is 7%. Now tell me, what is the amount I should be investing so that I get 12 lakhs per annum for infinite number of years from the pension plan for the time I survive? And if the rate of interest offered on that pension plan is 7%, what is the amount I should give as corpus to the company, the pension company? How much should I give? What is the amount I should give it to the company so that they give me 12 lakhs per annum for infinite number of years? Perpetuity means infinite number of years. So what is the amount I should be giving? 1.71 crores approximately. Right? 1.7 crores I should be giving it to the company so that I get 12 lakhs per annum for infinite number of years. This is very much applicable in the scenarios when we want a pension and we are not very sure of, yes. And we are not very sure of how long will I survive. Now, in this case, tell me who would be at an advantage. Why will the insurance company do this? What would be the advantage? What do you think? I'm going to give 1.71 crores to the pension company and pension fund, and they're going to pay me 12 lakhs per annum for infinite number of years. So this is the, and this I found in many of your paper, this particular part was not done correctly. So I thought, let me take it, the discussion on this and elaborate and explain it to you that you remember this for your life as well. Interest rate advantage, how, Eunice? How interest rate advantage? Now, this is for infinite number of years that you get it. You will get it, your nominee would get it. But in case it could happen that the pension funds, you don't know the number of years. For some of them, it could happen that by 65, it may get over. For some, it may get over by 70, 80, and so on. So the law of averaging, they are going to make the benefit. But as an investor, will I have the understanding that if I'm going to give 1.71 crores to the pension fund company, they're going to pay me 12 lakhs, whether I become from 60 to 70, 70 to 80, whatever be that infinite number of years. So is it on the same lines as when you buy the insurance and we pay the premium, but are we 100% sure that we are going to use the insurance benefit? Yes, absolutely right, Eunice. And they will also get the compounding benefit because you are giving it to the company at one go, you're giving it to the company 1.71 crores. They're going to make investment of that 1.71 crores. And from that 1.71 crore, they're going to pay you 12 lakhs annually. So definitely they will get a bigger advantage of the compounding, right? As compared to your 12 lakhs. Do we understand this concept? Very important. All of us would be doing it. If not at 60, you will do this at 70 because you don't know how long you're going to survive. So we may get into a perpetual annuity where you're going to receive the amount for infinite number of years. Any doubts here? The application part of it. Since many of you had done the mistake of this particular calculation, so I thought let me discuss in the class. Okay. Now, let's look at one more example. So, I'll show you another application of this. Mr. Bharat, the principal, wishes to institute a scholarship of rupees 5,000 for an outstanding student every year. He wants to know the present value of investment, which would yield 5,000 in perpetuity. So this principal wants to have the facility of giving out 5,000 as a scholarship to one student every year. And this particular school is going to be there for infinite number of years, right? Because we don't know that school will operate for 10 years, 20 years, and so on. So what is the amount that principal should invest from the college fund so that the school is going to get 5,000 every year for infinite number of years? So again, PV is equal to FVA, future value, divided by R. What is the amount? So it is going to be 5,000. Equal amount every year, discounted at 10%. So if principal is going to deposit 50,000 rupees today from the college fund, school fund, the college would be getting a scholarship of 5,000 every year for infinite number of years. Does it mean it is beneficial not to go for insurance and invest the same in some asset and earn better perpetuity? So Vinay, each of the instruments that is being offered in the market has its own benefits, and also it depends upon what are you looking at? What is the benefit you are interested in? right? There are a lot of asset classes, a lot of different types of instruments, but it depends upon each one of us, what is our requirement, and then we take up a call, right? For some of us, we prefer that our money should be invested in risk-free assets. For some of us, we prefer that, okay, I'm ready to take up the risk, so let me park my money in the risky assets. So it depends from person to person, family to family. What are you looking at? What are your requirements? What is your age? How many dependents you have in the family? So multiple factors are there. So there's not a one-stop medicine, shop medicines that you can say will suit all of us. It's going to be different. Depends upon the risk-taking capability that we have. It multiple factors are going to be there. Yeah. Any doubts on this perpetual? Very important concept. Any questions on this? Okay. Now let's look at this example, where I'm not looking at a simple future value. So last time we saw that if somebody had made investment of one lump sum amount, how much will that lump sum amount become after 10 years or 15 years, right? Now let's look at this case. So Manoj is investing 500,000, 1,500, 2,000, and 2,500 at the end of each year. And we want to know that what will be the value we will get at the end of 5 years, compounded annually, if the rate of interest is 5% per annum. Now tell me, this 500 that Manoj is going to invest, he will get interest on this amount for how many years? So basically, can I say this 500 would become end of the year? So how many years will he earn interest? 5 years or 4 years? It's as simple as, so when your HR has sent the mail that share your tax investment proofs, if you all make investment in the month of Jan, are we losing out interest for the financial year 22-23? Are we losing out interest for 22-23? If you're making investment now in the month of Jan because your HR has asked for investment proofs, are you going to lose your interest on that? Yes. You are going to lose, Jyoti. Are you going to earn interest for 22-23? So April, March, April, May, April, May, June, July, August, September, October, November, December. You haven't earned any interest, Jyoti, for the 9 months. Even if you will earn interest, it will only for be Jan, Feb, and March, right? You wouldn't earn it, yes. So tell me, what is the amount Manoj will get at the end of 5 years? So future value is equal to present value into 1 plus r raised to n. This is the formula that we had learned. Now, my future value will be equal to 500 into 1.05 raised to, I'll do only 4. If the same amount was invested at the beginning of the year, I would have earned interest for 5 years, but now it will become raised to 4. 1,000 rupees that is going to invest, right? On this is going to earn interest only for 3 years. And that's always we say, never make investments at the end of the year. If you have money, make investments in the month of April, May, whatever, as soon as possible, I would say. So what is the amount this gentleman would get at the end of 5 years? And the last 2,500, which is making investment, will he earn any interest on that? The answer is no. He will not earn any interest on that. And that's why we recommend all investment should be made at the beginning of the year and not the end of the year. What is the amount that he would earn? Ganesh says 8,019 rupees. Just check if you agree with him. Yes. Do we agree with Ganesh? Let's see. Perfect. Ganesh has said 8,019. So the answer is 8,020, which is absolutely right. What would be my answer if all this investment was made at the beginning of the year? If all this investment was made at the beginning of the year, so can I say, if all the investments were made at the beginning of the year, so can I say my answer would have been future value is equal to 8,019, and I would have earned interest for one more year on that? I would have earned interest for one more year. So 500 into 1.05 raised to 5, 4, 3, 2, and 1. Can I say that would have been my years for getting the returns? If investments was made at the beginning of the period, my years would have been 5, 4, 3, 2, and 1. Yunus says it would have been 8,420 if your investments was made at the beginning of the year. Done? Any questions here? Are we done or we are doing it? Done. Okay. Now, where will be the application of this future value of an annuity? This formula also you have seen 1 plus r raised to n minus 1 divided by r. If it is ordinary, ordinary means end of the year. Annuity due means beginning of the year. So you multiply it by 1 plus r because you will earn interest for one more time. You have seen this in your earth-sync material. Where is the application of this? So you're saying your future value is PVA. So can I say this is an example of SIP investment where I make equal amount of investment every year? So I want to know how much would be the amount at the end of the investment period. Can we say SIP investment? Recurring deposit will also be application of this. What do you say? Recurring deposit, also application of the same, where you make equal amount of investment every year and you want to know what is the amount you would receive. Say, for example, if I need that I want rupees 5 lakhs after 2 years. So I want to know that what is the amount I should be putting it in the bank every month or every year so that it becomes 5 lakhs in a span of 2 years, getting the benefit of compounding and so on. And if I do the investments at the beginning of the year, then it is annuity due. That means I will earn interest for one more year that you can see here, 1 plus I or 1 plus R. And if I do it at the end of the year, I do not earn interest for one more year. So there are two things that you would have done multiple cash flows in your earth-sync material. One is FV is equal to PVA into 1 plus R raised to n minus 1, and the whole is divided by R. The application of this is your SIP. Fine. You've done PV is equal to FVA. FVA means in the future that you're going to make your EMI payments. Everything else remains the same in this, okay? This remains the same. Only thing happens is here it becomes multiplied by 1 plus R raised to n. This is an extra term. Let me remind you how it is easy to remember. Okay, let me tell you. Now, can you see this is my PV? PV is always equal to FV divided by 1 plus R raised to n. Do you remember that? Whenever you write PV, what is the formula for PV? PV is equal to future value divided by 1 plus R raised to n. So you'll have to remember only one formula, rest will automatically fall in place. Now, in this case also you can see PV. So whatever is a future value, till here it is a future value that you can see. Till here it is a future value that you can see. Whatever is the future value divided by 1 plus r raised to n. Is it same thing or not? So you have to remember only one formula. If you remember this one, that's okay, because the other one is PV is future value divided by 1 plus r raised to n. Is it simpler to remember? Is it simpler to remember? Or should I explain again? Okay. Okay means it's you've understood, or you want me to repeat? Okay. Now tell me to this one. Sure. Concept is based on Vinay. So when I'm writing future value is present value annuity into 1 plus r raised to n minus 1 divided by r. Whereas the application part of this is, the application part of this concept is used when you're doing SIP investment. So what you want to know is that what is the amount you will get in the future if present value annuity. If today, present value, every year you're making an equal amount of investment. That is your SIP investment. The other concept that we use is PV, where equal to FVA, right? And the same concept comes into PV is FVA into, the same formula will be there, but it is going to be, where is the application part of this? Application part of this is going to be in the scenario. Give me a moment. Application part of this is going to be in the scenario where I want to know that what is the amount to be invested today so that I can get equal amount in the future, or what is the amount of loan I can take today so that I have to pay an equal EMI in the future, future value annuity, equal amount that I have to pay in the future. Clear, Vinay? The application part? Because in that case, Vinay, PV is equal to FVA divided by R. This is for the scenario where it is for infinite number of years. Infinite number of years. Whereas in the above, your number of years is finite. You know it is for n number of years. You know it is for n number of years. Whereas in this case, it is for infinite. N is infinite. You don't know the number of years that you are looking for an equal amount in the future. That is the difference between the two. Yeah. Now coming to multiple cash flows, this is the, what is the understanding of multiple cash flows? So you know that the amount that you're going to receive in the first year, second year, third year, and fourth year, you want to find out the present value of that amount. How would you find? So this amount that you're going to earn in the first year, in the second year, the third year, and the fourth year, the amount that you're earning. So you need to discount all of them to the present. How would you do that? So what is the formula that you will use? My present value is equal to future value divided by 1 plus r raised to n. Now, when I have to discount this for multiple cash flows, how would you discount? what is the amount I should be investing today so that I get, as a company, as a corporate finance manager, I get 1,000 rupees in the first year, 2,000 rupees in the second year, 3,000 rupees in the third year, and 4,000 rupees in the fourth year. What should be the amount that I invest today? How should I do the calculations? How would you do? What is the amount to be invested today? So the first amount that you're receiving it, that is 1,000 rupees. So your N is going to be what in this case? When you're discounting into the present, how many years would you put? Yes, why add them? Say present value is going to be equal to 1,000 divided by 1 plus R. So 1.1 raised to, what should I do? 1 or 4? What should I do? Jyotishman, you have raised your hand. Is it by mistake or you have a question? 1. Raised to 1. Second one will become by mistake. No issues. Second one, you are going to get 2,000 rupees. You need to discount that to the present. So you need to discount that by 2 years, right? And so on. So tell me, what is the amount I should invest today as a company so that I get 1,000 rupees in the first year as the cash flow, 2,000 rupees in the second year, 3,000 in the third year, and 4,000 in the fourth year. What should be the amount to be invested today? Tell me. So 7,548 as per Yunus. Anyone has any different answer, or do we agree with him? Right? Okay. 7,446, which is absolutely fine. It's just the number of decimals that we have taken. Clear? Now, do you think this also is what will be the application of it? So say, for example, whether you take it in your personal life or you take it from the corporate finance manager perspective, what is the amount I invest today so that I can get a not equal but unequal cash flows in the future that I want to know? This we have already discussed. You have seen this formula or the way I wrote it. Both are absolutely fine. It's the same thing, right? What we wrote, it's the same thing. 1 plus R raised to N minus 1 divided by R into 1 plus R raised to N. Whichever you like it, I prefer that the student should remember only one formula. The present value, you can just do future value divided by 1 plus R raised to N. I prefer that. It's easier to remember. Now let's do a few application questions before we move on to capital budgeting, which is very, very important concepts again. Tell me this sheet I've shared with you for today's session. Just open up this sheet. So let's work together. And again, tomorrow morning, I will share this file as a post-session file with you all with the help of the coordinator. Open up this sheet. Let me know once you're ready. You have this document. Check. Today's session, live session 3. Others, please check. Not available. Not received. You'll give me a moment. I'll just call up the coordinator because I want you to have this sheet. Just give me a moment. Yeah, getting it checked. I think it is all uploaded. So if there's in the drive, do you see live sessions or how do you see the in the portal? Live session 3 folder itself is missing. Okay. Okay, getting it checked. Okay, till then you can look at my folder question. It'll get shared, don't worry. Look at this and tell me what would be the answer. Ankit says 11,051. Is it a case of ordinary annuity or annuity due? Is it a case of ordinary annuity or annuity due? Ordinary, right? Because all are done at the end of the year. Ordinary annuity it is, right? So the sum of money he will have at the end of the 5th year. So definitely I'm looking for future value is equal to how much should I invest every year now, right? And I use the formula 1 plus R raised to n minus 1 and the whole divided by R. Put in the values and what I can see is 11,051. So the application part of it is that if I deposit a recurring deposit at the end of 5 years, if you don't consider time value of money, your money would have been 10,000 rupees. But if you consider the compound interest, you see that 2,000 every year becomes 11,051 in a span of 5 years. The benefit of compounding. Look at the next one. The sheet will reach you tomorrow. I'll connect with the coordinator once again. I did check and it has been shared. But anyways, whatever be the loophole, we'll get that sorted. I'll connect with the coordinator tomorrow morning once again and get those Excel sheets as well as this uploaded. So that tomorrow evening when we are meeting the last, so we have all the sheets common. Which formula would I use here? PV or FVA? 29,831.56 according to Ankit. So which concept am I going to use here? PMT, right? Absolutely right. But I would also have to know the Excel would not be there in the exam. So you should know this formula as well, apart from the Excel formula. Excel is, but apart from that, you should know this formula as well as given in the async material also. And it's easier to remember because whatever is PV is FV divided by 1 plus R is to N. So to remember just the top one. So according to this, according to Ankit, it is 29,831.56. So every year I have to pay 29,831 rupees so that I can borrow 1 lakh rupees for 5 years. Done, everyone? Should I go ahead? What would you do in the third case? Yes, any doubts, any questions for me? No. Okay. Third one. Which concept are you going to use? How much can I withdraw annually for a period of 10 years? So definitely I'm talking about future value. I'm talking about future value. So I just got a call and the moderator would be sharing the path with you where the files are uploaded. The files are already uploaded. I just connected with the coordinator. So the call, got the call back from her saying that the files are uploaded. So maybe the moderator would share the path with you. Yeah. Okay. Third one. How much can I withdraw annually? So definitely I'm talking about the first formula or the second one. I'm going to withdraw this amount in the future. I'm going to withdraw this amount in the future. First one, no, not the first one, definitely not. I'm going to withdraw it in the future, equal amount in the future. So first one or second one, what do you think? I'm going to withdraw equal amount in the future. So that will be the second formula. PV is equal to FVA1. I'm going to withdraw. Today, I'm going to deposit 3 lakh in the bank. That is present value. How much can I withdraw in the future at the rate of interest of 10% for 10 years? So what am I asking you to find out? I'm asking you, how much will I be able to withdraw in the future for the next 10 years if the rate of interest offered to me is 10%? Ankit says 48,000, but I'm looking for someone to confirm if this is right or wrong. And if you want me to solve it, I would definitely be doing that. How much is that amount? Should I solve? If you're quiet, I have no idea. So 3 lakhs, should I solve or we are doing it? Should I wait? Say something. You want me to solve, Gaurav? Okay. So what is the present value of the amount that father deposits is 3 lakhs. 3 lakhs is depositing today. So what is the amount he can withdraw in the future? Into, because you're withdrawing this amount in the future, not today. So what is that equal amount that you can withdraw? 1.1 raised to 10. Right, minus 1, and here R will become 10%, and here it will become 0.1 raised to 10. How would you solve this is, sorry, this will become 1.0.1. So just do 1.1 raised to 10. You will get answer as 2.5937. From that, subtract 1. So it will become 1.5937 divided by 0.1, again divided by 1.1 raised to 10. So the value of this number, what you see is this number that you see on the right-hand side would be 6.144. Has everybody got that? Have everybody got that? So follow the rules of the BODMAS. You will solve this part first, and then get it. Yes, so my equal amount that father can withdraw sometime in the future is going to be equal to 48,824 rupees. You can work backwards also and find out that if I want to withdraw 1 lakh every month or every annum, what is the amount I should be investing today? You can work backwards as well. Or in the case of companies, if they want a certain amount of cash flow to make the interest payment to the debenture holders, they would want to know that what should be the amount of the sinking fund that they need to create. What is the amount of corpus that they need to invest so that they are getting enough money to make the coupon payment or the interest payment to the debenture holders? Are we clear on this? Yeah. Okay. Mahesh one is similar to above, check. And if it is, so you should be able to quickly tell me the amount. Mahesh deposits rupees 2 lakhs in a bank account, which pays 10% interest. How much can he withdraw annually for a period of 15 years? So again, we are talking about how much Mahesh can withdraw every year for 15 years. And if the rate of interest is 10%. Again, it's the same concept. So quickly tell me the amount. Okay, so there is a message from Pranjay. Document files have been shared on the Telegram channel as well. And even I hope session 2 files are uploaded. So Pranjay, if you can share the path as well with them for the drive, because the files are already shared and they're not able to locate.
Sure, ma'am, I'll ask for the path, yeah.
Yeah. Ankit is quite quick. Ankit, but you will have to practice it without the Excel as well. Yes, Ankit? Great, great. Because both formula as well as the Excel is given in the async materials, you need to be prepared for both. And if you're doing both, great. Then I must say you're quite quick. That same concept, so I will not waste time there. Let's look at fifth one. Just want to know, if I am Mr. Swami, what is a choice you will let me know? Which is a better choice for me to go for? Should I take an annual pension of 20,000 as long as I live? Or should I take a lump sum payment of 1,50,000 from the insurance company? If the rate of interest in the market is 15%, which one should I go for? So which concept would you use here? Perpetuity one. So can I say, what is the amount I should invest today? So that basically I'm getting this amount from the insurance company. So should I tell insurance company that give me 20,000 for the number of years that I'm going to survive? Or should I say insurance company that you give me 1,50,000 today? Which one would you suggest? Can we keep the concept very clear that I would prefer the one where I'm going to get a higher present value? Would you say that you would prefer the one where you're getting a higher present value? You'll prefer the one where you're getting the higher present value. Would you prefer that? Yes. So how much would be my present value here? So 20,000 if I'm going to get for every year for the time I'm surviving, divided by 15%, would I prefer that or would I prefer the second option? 1,33,333. So would you go for the first or the second option? Which present value is higher or lower? So Pranjay has shared the file path with us. So if you're not finding out any file, second session or the third session, it's all there. Thanks a lot, Pranjay. Yeah. So which one would you want to go for? The first or the second one? So insurance company is asking you, which one would you want to go for? So definitely you'll go for the second one. Why? I understood it's a higher value, but still my question is why? Can you invest and get more returns on that? Is that the reason? Can you invest that amount and get a more returns on that? Is that the reason? If I go for annual pension of 20,000, but tell me one thing, if we did not know the concept of time value of money, wouldn't this would have been lucrative to say that give me 20,000 for the time I survive? Wouldn't it have been lucrative if you did not know the concept of time value of money? What do you think? Wouldn't it be lucrative? That, oh, I don't know whether it will be 20 years or 30 years, but actually if you put the finance and time value of money together, you see, oh, it's not that lucrative because you have an opportunity cost. And if you take 1,50,000 today, it's a better deal as compared to taking 20,000 for as long as you survive on planet Earth. So that's going to be a better deal for you. Right? Done, everyone? So now we move on to something very interesting. And now I'm again taking you back from your personal finances and trying to make you understand the time value of money using the personal investments. Now I'll take you back to the corporate finance. Sure. This one. Okay. This sum? Yeah. Okay. Let me wait. Got it? Okay. Anyone, any questions? Done? Can we go ahead? Okay. I'm moving on to another very, very important discussion, concept of capital budgeting. So there's something called capital rationing, capital budgeting that you would have heard about it in your earning material. What's your understanding of capital budgeting? Do you all agree with this fact? And even in your economics, you would have learned this, that money is a limited resource. And the entire economics and concept of economics, the scarcity of resources, optimum utilization of resources, to think capital budgeting is also on the same lines. And we want to make sure that how best the allocation of resources can take place so that it can give long-term benefits to the company. Can we say that? How well the resources of the company can be invested so that we can get the benefits in the long run. And that's why we need to do capital budgeting. All of you working in the corporate, do you have only one project, no options to make investments? So many times there comes a scenario where there are multiple options in the market and multiple projects in the market, multiple clients in the market. and you would have to take up a decision to make investment in only one of the project. Hasn't it happened or not? Has it ever happened that you're confused which one to choose? Yes or no? And how do you choose? So how do you choose then? That, okay, whether I should go for project A, should I go for project B? So either it could be a qualitative analysis where you look at the features, you look at the long-term relationship, or it could be quantitative where you see that which project is going to give you more benefits in terms of rupees in the long run. So you look either at the qualitative data or you look at the quantitative data to understand which is the better project to make the investment, right? Because money is a limited resource, resources are limited. You definitely want to look at those projects to make the investment that's going to give you benefits in the long run. Do we understand the difference between profit and wealth? So profit maximization and wealth maximization, do we understand the difference between the two? What is that? What is the difference between profit maximization and wealth maximization? Wealth is long term. Yes. So Nazneen, can I say profit is your net profit that you're looking at? But whereas if you're looking for wealth, we are looking at earnings per share. Earnings per share to the shareholders. Can I say that to be a long-term perspective of the company? Can I say that to be the vision of the company? Yes, Nazneen? So profits you can get even for a short term. The company can but if you try the wealth maximization where you try to bring down the cost in the long term, we're working on economies of scale, and then you try to reach out to the increasing the earnings per share to the shareholders in the long run, the vision of the company, that becomes the wealth maximization. So when the companies have projects to make the investment, do you think it's a short term or mostly they are long term decisions? Whether it is in terms of expanding and expanding to another plant, or whether it is in terms of buying a new machine, it's a long term. Is it reversible? Can I say, TK, no mood, tomorrow, today we have decided to set up, tomorrow let's change the plan. Day after tomorrow, let's go to another plan. Is it possible? No. You have to stay right. You have to stay with it. You make an investment, long-term investment. And can it also happen to buy this machine or to expand the plant? You would have borrowed money from the market in terms of IPO or the debt market. Can it happen? Can it happen? Yes. And can you reverse the situation where you say that, okay, today I've come for IPO and I want to buy back my shares in another 2 months? Not a very good image. So this capital budgeting techniques or the capital budgeting decisions that we talk about is from the long-term perspective of the company, right? Where they're looking for all the factors of production is going to be variable. They're talking about buying the fixed assets of the company, buying the machines of the company, decision that cannot be reversed, decision once taken. It's more from the vision perspective of the company and not from the short-term perspective, right? So all the capital budgeting where you are thinking that how to allocate the money in those projects which is going to give you the best return on your investment in the long run, not in the short run, right? In the long run. Remember this, because when I'm doing the techniques, we want you to understand this fact. All of them, the decision that is taken is for a long term. Another thing is, when any company plans to expand, right, they try to estimate their profits. Does it also have an impact on the USP of that company, or I would say the competitive position of that company in the long run? Right? Absolutely. Hmm? Cash forecasting. When you, as a company, as a corporate finance manager, you are planning to make investment in a project. So you're looking at the wealth maximization. Do you also look at what could be the probable cash generation from this project? Is it important? Is it important to know that what could be the probable cash generation from this project? So that you're able to, would you make investment without expecting any returns from that investment? The answer is no. Definitely, you're going to look at the cash flows that you would be generating from that investment. And then it should generate wealth maximization in the long run. That is more earnings per share in the long run that you are looking at. Now, before I take you to any kind of decision, let's understand there is something called the independent project and mutually exclusive project. Mutually exclusive project means, say, for example, I have to select from either of the two vendors. Now, for the buying the same material. So if I select vendor A, I have to reject vendor B and vice versa. So mutually exclusive means out of two projects, only one can be selected. That is called mutually exclusive. Independent, it can happen that you can select both of them as well. Is the difference clear to all of us? Fine. So mutually exclusive, you select project A, you cannot select project B and vice versa. Independent, it can happen that you can select both project A as well as project B. That is what has been explained here. Now, if you are the finance manager of the company and you have to understand that which are the projects to be made investment. So the management first has to explore the opportunities in the market. How many of you are coming from, how many of you are project managers in this group? Any project managers? Any project managers in this group? No. No project managers? Any of marketing people here? Or sales? Okay. So any of the project that you get as a project manager, so you look at multiple opportunities in the market. Then you look at that opportunities and evaluate the opportunity qualitatively and quantitatively. Qualitatively means you can look at it, the project that in the long run, how beneficial it would be for different stakeholders of the company. When I use the word stakeholders, what do I mean? What is stakeholders? What is the meaning of stakeholders of a company? Example would be, yes, example would be creditors, debtors, banks, employees. Can they all be called the stakeholders? Yes. Okay. Now, in your accounts, you have done something called the profit and loss statement, right? When you saw the profit and loss statement, does it look like this? My sales revenue, that is my top line, what we say, sales revenue minus the cost of goods sold, or you can say the operating expenses, you get earnings before interest, tax, depreciation, and amortization. From this, you take away depreciation and amortization, you will get the operating profit. Take away interest, you get earnings before tax. Take away tax, you will get your PAT. Remember this? Accounts. Right? Do you remember this? Yeah. And to the PAT, if you add back depreciation, which is a non-cash expense, we get our cash flow. We get our cash flow, right? So when you're doing a capital budgeting decision, so there are two major things that we need to remember is there is an investment activities and there is a financing activities. So when I'm talking about capital budgeting, am I talking about investment activity or financing activity? Tell me that. So when I'm talking about capital budgeting and trying to understand that which project I should be selecting for making the investment, I'm talking about investment activity. So in the process, it says that we need to explore the opportunity. And once we explore the opportunity, we need to evaluate the opportunity and find out the cash flow from the project and then select our project after implementing the capital budgeting techniques. And you said that's an investment activity. So can I take away the interest component from here? Because it is investment activity. Can I take away my interest component from here? Tell me yes or no. Because if I include interest component, because interest would anyways be there whether I select project A, project B, or whatever. And since I'm talking about only the investment activity, when I'm doing capital budgeting and when I'll try to estimate the cash flow from the project, can I remove the financing activity interest component from that or not? What do you say? Preference dividend, interest component, I would remove it. That is part of your investment activities. And if I include interest, that becomes part of your financing activity. So in the case when I'm evaluating the project to decide whether the investment has to be made in a particular project or not, we are not going to look at the financing activity interest component or the preference dividend component. So it will become sales revenue. Whatever sales I'm going to generate from that project, take away all the cost associated with that project, I'll get my earnings before tax, depreciation, and amortization. Take away depreciation and amortization, I'll get my earnings before tax from the project. Take away the tax, I'll get profit after tax from the project. Add back depreciation, I will get the cash flow. This you will have to remember it, because tomorrow when I'm going to deal with the comparison of projects or finding out estimation of cash flows for the project, you would have to remember this. Shoot questions if you have any doubt. So Eunice, what I'm saying is there is investment activity and a financing activity of the company. So what you have seen in the profit and loss statement, you have the investment activity and the financing. But when I'm doing my capital budgeting activity, is it core investment activity? Am I trying to just get that if I make investment in the project, what is the cash flow from that particular project? Am I trying to understand that? Because borrowing you will do for any of the project, whether it is project A, project B, project C, any project. But if I want to understand that should I go for project A, should I go for project B or project C, I have to very clear in understanding that I have to differentiate between investment versus financing activity of the company. Investment versus financing activity of the company, I need to be very clear on that. Now, when I'm doing capital budgeting and trying to understand which project is a better project for me to make the investment, I will take away only the investment component and calculate the cash flows for the project, and then use capital budgeting techniques to understand which is a better project for me. So basically what I want you to understand here is that my investment and my financing activity are two different activities. And when I'm just taking up the decision whether to make investment in a project or not, I would look at the investment activity and not the financing activity, right? We'll come to know this further when we are doing the comparisons, so don't worry about it. But just keep this at the back of your mind. Don't worry more than that. That you will understand when I'm doing the examples tomorrow and today also. Okay, all right. So this I'll come back in a bit, because right now if I talk about it, you'll get confused. I'll come back to it later. Now, when you're making your investment decisions, when you're deciding whether I should go for which of the project, definitely you would want to select the project that's going to increase your sales revenue and bring down the cost, agreed or not. When you're selecting the projects, would you have in the back of your mind that you would want to select the project which is going to increase your top line and reduce your cost? Would you prefer that or not? Your sales revenue should increase and your cost should decrease. Would you want that such projects or not? Right? That is what you have to keep that in mind. Any investment that we do it, we have to take up a call whether I want to accept the project or reject the project. And if it's mutually exclusive, which one of the 2 or 3 I have to select. And if I select one, definitely it means I'm selecting the others. And capital rationing decision means how are we allocating our limited funds to various projects? That is called capital rationing. How are we allocating the funds to various projects? Because money is a limited resource. Any doubts on these points? Because this application of it would come the last module that you have seen in your nursing material that I'm going to deal with it tomorrow. That's going to be based on all this. So you'll have to keep this in mind. Are we clear? Any doubt on this? Okay. When, as a finance manager, you're selecting the project, do you also need to look at the risk and the return component? Is it important to know that what is the risk associated with the project and what is the return associated with the project? Is that also important? Very much. Would you prefer to make investment in a project that gives you the best risk return trade-off? That gives you the best risk return trade-off? Would you prefer that? So that means if you are ready to bear higher risk for a project, do you want to get compensated for that higher risk in terms of higher return? High risk, best return with the less risk. Okay. But generally the funda is, if any project you're making the investment, the risk and reward, higher the risk, higher the reward, right? And the types of risks that the firms face is the business risk. That is the risk that comes up because of the business that you are in, financial risk, macroeconomic factors risk. A lot of risk has to be considered. Now, just tell me, COVID-19, did it had impact on the capital budgeting decisions of the company? Do you think it would have an impact? 2021, when the companies would have wanted to expand, did they halt the plan of expansion? Right? So it could be a business risk, it could be a non-business risk, it could be a financial risk. So these risks also has to be considered when you're evaluating is this the right time to invest in a project or not? What is the return that you can be expecting from the investment, and so on. You have to definitely be looking at that perspective as well. Now, so one is the qualitative angle that you would look at, the risk return trade-off you would look at. And there's another factor that altogether you look at is how do you find out from multiple projects which is the best project for me to make the investment? So that we say the quantitative analysis of capital budgeting. So we have two major methods. One is called the discounted cash flow criteria, and the other one is called the non-discounted cash flow criteria. Discounted cash flow criteria, and the other one is called the non-discounted cash flow criteria. Discounted cash flow criteria means you're going to use the time value of money. Discounted cash flow criteria means you're going to use time value of money. Non-discounted cash flow criteria means you will not use the time value of money. You would have gone through the earning material, something called the payback period. Payback period. Did you consider time value of money in that? No. We did not consider time value of money in that. So that is non-discounted cash flow criteria, where you did not look at the time value of money criteria. Right? And discounted is your net present value, your profitability index. All these are discounted cash flow criteria. So understanding the time value of money discussion that we had since the last 2 days, what do you think? Would you prefer as a corporate finance manager discounted methods or non-discounted methods? Which one would be preferred for you to take up the decision that which is a better project to be invested? Which one would you prefer? DCF. Definitely the discounted cash flow criteria. So in investment value criteria, we look at the payback period, net present value, internal rate of return, profitability index. Yes, so these are the different methods, criteria we are going to look at. Now coming to the first one, but before we start with the criteria and before we go to the application part of it, are we tired and do we need a break first, or can I continue? Because then I'll get into the application part of them. And also how to estimate the cash flows. So are we good, or should we take our break first? I think let's take the break so that we come back and get into the topic full-fledged. Yes. So let's meet in, Ganesh says only 5 minutes. I'm quite happy with that. But usually we take 8 minutes. So is 5 good or 8 good? So let's meet in 7 minutes. 8 minutes. All right. So let's meet in 8 minutes. See you in 8 minutes. And then we'll continue with the discussion. Till then, please check the path and see if the files are uploaded. That would be of great help. Yes, are we all back? Yeah, okay. So the first one is payback period. Traditional method, time value of money is not used. What is the meaning of the payback period is how long will it take for me to recover my initial investment? Now, if you are the corporate finance manager, do you want the recovery of your money faster or slower the better? If you are the say for example the corporate finance manager, do you want it faster the better or slower the better? Faster. So you want the payback period to be as big as possible or as small as possible? As small or as big? As small as possible would be a better deal, right? Absolutely. Now, in this case, the only thing is that the time value of money is not going to be considered. So look at the first example. What do you think is going to be the payback period? What is going to be the payback period here? So in this case, 1,50,000 is the outflow, and per year you're getting 30,000. Very easy. How long will it take for the company to recover? 5 years. That is very, very easy. Payback period is going to be 5 years. Now, say for example, the management decides that the benchmark payback period they're considering is 4 years. Now, say for example, the management says that the benchmark payback period we are going to consider is going to be 4 years. Now, in this scenario, would you select this particular project where the project is giving you 5 years payback, but the management decides that the benchmark payback is going to be 4 years? So what would you do? You would definitely reject this particular project because it does not fall in your timelines, right? So this was simple one when every year you got the same amount. Is it practically possible in the projects where every year you get the same amount? Is it practically possible that every year you get back the same amount? No. So let's look at the second practical case where the project life is 4 years and every year you're getting a different amount of cash flow from the project. Now tell me in this case, what would be the payback? I want exact payback. What would be the payback period in this case? So can I say, if I look at the amount 7,600, can I get a rough estimate that the number is between 1 and 2 years? Can I say my payback is between year 1 and 2? Can we say that? That payback is between year 1 and 2, right? But how much exactly? So let's see. Payback period is going to be equal to 1 plus something. How much is the amount that I need to recover in the second year? How much is the amount that I need to recover in the second year? Is it 7,600 subtracted from the outflow? That is the remaining is 1,600 that I want to recover. Yes or no? And from where will you recover this amount? From the second year cash flow. So this is basically how much to be recovered? 1,600. From where to be recovered? The second year cash flow. So that you will get the exact payback period, exact month, days, whatever you're looking at. How long will it take for you to recover your initial investment? So your answer is going to be between 1 and 2. How much is to be recovered from the second year? 1,600. From where will you recover? 2,000 rupees. So that would be how much? How much is 1,600 divided by 2,000 rupees? So that is 1 year, 1.8 years is the answer, right? 1.8 years is going to be your answer. This is payback. Did I consider time value of money in this? Did I consider time value of money in this? No, I did not consider time value of money at all in this, right? But practically, if you see, is not a great way, because if value of money keeps on falling. So if I'm not looking at time value of money, it may not be a great option for me to look at. So what should I do? Will I use the other one, that is a discounted payback period? In discounted payback period, what is the difference is you would be able to get the value as per time value of money, right? Now, if I look at these values, do you think 6,000 rupees after 1 year today, the value be same as today, or will the value fall because of inflation, uncertainty, and so on? Will the value fall? Do you think so? Right? So can I find out the present value of this cash flows? Can I find out present value of these cash flows? What will be the discounting factor at which I'll find out? At 12% per annum, I'll find out the present value. How would you find out the present value? My present value is equal to future value divided by 1 plus r raised to n. This is how I find out my present value. So tell me, how much is going to be the present value of 7,600? Will it be the same? Will 7,600 be the same amount? Yes. What will be the present value of 6,000 rupees? Will it become 6,000 divided by 1.12? How much would that be? Because raised to 1, 5357. And how much would be the value of 2,000 rupees? 2,000 divided by 1.12 raised to 2. So 1594. I hope no issues in finding out the present values. Third one. $712, and the fourth one. Fourth one. $3,177. 712 and 3,177. Now tell me, what is the discounted payback period? Now, instead of looking at 6,000 and 2,000, I would look at 5357 and 1594. Will my answer be between 1 and 2 or 2 and 3? Will my answer be between 1 and 2 or 2 and 3? 2 and 3. So that means right? So that means I'll just do it over here so that you are able to see. My discounted payback period is going to be equal to 2 plus. How much is the amount to be recovered in the third year? It is going to be 7,600 minus 5,357 recovered in the first year, 1,594 recovered in the second year. So remaining is the amount that I would have to recover it in the third year. From where will I recover? I will recover this from 712. So what will be my discounted payback period? 2.9 years. Did you notice here that my discounted payback period is greater than my payback period? Any particular reason? Why my discounted payback period is greater than my payback period? What could be the logic? Why is it greater? Consider time value of money. And if you consider time value of money, the value of your rupee is falling. The value of your rupee is falling, right? And if the value of your rupee is falling, then what's going to happen? I will take little longer to recover the initial investment, right? My value of my rupee is falling. So definitely I'm going to take longer to recover the initial investment, right? So in all the cases, my discounted payback period is going to be greater than your payback period, fine? So very similar, both of them. So if it is just a difference in the calculation in terms of one is calculated on the present value of the cash flows and the other one is done without that. That's all is the difference between the two. So this was about the payback and the discounted payback period, because once I revise through this quickly, then I would be able to go to the real application part in the form of caselets. And then tomorrow we'll be able to look at the full-fledged projects and do the entire thing. That's the reason I'm just creating the background. So you will, in case of payback period, whenever the calculation that you have done is lower than the standard or the management payback period decided, only then you will select the project, else you will reject it. Formula you don't need to remember. Isn't it logic based? You don't have to remember the formula, right? It's all logic based, that how long will it take? No need to remember the formula as such. Net present value. So in payback period and discounted payback period, we came to know the number of years it will take for me to recover the initial investment. In net present value, if I want to know that how much is my present value of cash inflows greater than my present value of cash outflow, matlab, how much money I am receiving from the project, the present value of that money, how bigger or how greater it is as compared to the present value of the cash outflow. Do I want that number to be positive or negative? Do I want that number to be positive the better or negative the better? Positive the better? The number has to be positive, then it's going to be more better. That means the amount that I'm earning from the project is definitely greater than the amount that I am going to invest in that particular project. Tell me quickly to this one. Tell me this one. This is negative. What does this negative means? What does this negative means? Outflow. So tell me, I've taken up a small number, that what is going to be my NPV? So definitely first I will have to, can you see this cash flows that I was talking about? Tomorrow we will see the estimation of this cash flows, which is the last module that you have it in your housing material as well, where you are trying to find out the projects and analysis, what if analysis and everything. So you can see your cash flows. This is just the cash flows from the investment activities. So I invest 25,000. The first year I get 15,000. Second year I get 23,000. I need to find out the net present value. So I can do definitely and find out present value of cash flows. Quickly tell me the values of the cash flow so that we can estimate what could be the net present value of the project. So 15,000 divided by 1.12. First one, nothing will happen now, because anything raised to 0 will become equal to 1 itself. Nothing is going to happen to that. First one, nothing is going to happen. First one would remain the same, no changes, right? Yes. Second one and third one, tell me the values. Done? Okay. So 18, 30, 35 is second one. And third one is 13,392. NPV I've got as negative. Others to be agree. So NPV, I have got it as present value of cash inflows. So 18,335 plus 13,392 minus 25,000. Is it negative answer? 6728. Is it so? Everybody has got the same? Now, what are you saying here? You mean to say that when you're making investment in the project, the amount that you're receiving, is it negative or positive? It is positive, I believe, not negative, because this amount is much bigger. Positive. Yes, positive. Will you accept the project? Definitely, it is greater than 0. Your amount you're earning is greater, so it is going to be accept the project. But this all you have seen in the async material as well. Now, tell me in NPV, you're getting the amount in rupees. In payback period, you're getting the number of years. But can it happen that I have two mutually exclusive projects, and both the mutually exclusive project, you are not having the same amount of investment? Then what would you do? I have two mutually exclusive projects, but investment amount is not same. Then what would you do? Would you prefer NPV or would you prefer the ratio of the two? I have two projects, mutually exclusive, but not of the same investment amount. Would you prefer to calculate NPV or would you prefer the ratio, that is profitability index? What would you prefer? Profitability index, right? So especially in the scenarios where we see that we have two mutually exclusive projects, but the investment amount is different in both of them, then we would prefer profitability index so that I come to know the ratio as compared to the rupee value, right? As compared to the rupee value, I would prefer that. Okay. Tell me the answer to this one. In fact, this question itself, tell me PI, same question itself. What is my profitability index? Absolute terms, you will prefer it. NPV definitely would be preferred. Definitely. And even if it is mutually exclusive projects, between NPV and IRR, which one would you prefer? Let me check. Yes, you're absolutely right. That was a typo error that I have done. Here it will be 13,392. And here it will be definitely yes. Agreed. Profitability index would be what? Between NPV and IRR, which one would you prefer if it's mutually exclusive? IRR can give you contradictory results as well. In that scenario, what would you prefer? NPV or IRR? NPV, right? Okay, quickly tell me PI for the same one. Done. Would you accept it? Would you accept? 1.26. That means your inflow is going to be greater than the outflow. It's greater than 1. Would you accept or not? Yes, definitely. NPV greater than 0, PI greater than 1 is something that I would definitely be preferring to make the investment. Payback period, smaller the better. Smaller the better. Discounted payback period, what's your thought on that? Discounted payback period, bigger the better, smaller the better. Smaller the better. Right, absolutely. Okay, so NPV we are done. We are done with the payback, discounted payback, and profitability index. Should I give you one-stop solution so that all of them we get to do it together? Let's look at case number 6, and then I will go to the case study. Straight away to the case study post that. So one question, all the methods. So profitability index is another name we call it, is called the benefit cost ratio. So profitability index, or the other name that we give to it, is called the benefit cost ratio. It's one and the same thing for your information. Okay. Profitability index or the benefit cost ratio is one and the same thing. So here the project has been given 10,000, inflows are given. We need 10% as the cost of capital. We need to find out the payback, discounted payback, net present value, profitability index, all at one go, so that then I can go straight away to the case study. So let this be the year. This should be the cash. And this should be the present value of cash flow. How many years we have? 1, 2, and 3. This I can delete. So my cash flow here is 4,000, and here it is 5,000, and here it is 4,000. What is my present value of cash flow? What is my discounting factor? My cost of capital. I'm going to consider it as 10%. Tell me quickly the values. So SNI has given me straight away the NPV, but I wanted to know the present value of the cash flows. But then it is easier for us to calculate all of them at one go. 3636, then 4132.23, and the last one is 3005. Perfect. This one also I'll just approximate it. Right now, first we'll calculate our payback period. So invested 10,000. Where is my recovery? Is it happening between 2 and 3? Payback, third year completely it is happening? Or approximately 10,773. So slightly less than 3 years and slightly and more than 2 years. So 2 plus, how much is to be recovered in the third year? It is going to be 10,000 minus first year I have recovered 4,000, second year I have recovered 5,000, and this would be recovered from 4,000 in the third year. What is the exact payback period? 2.25, perfect. Okay. Go ahead with the discounted payback period. So this is going to be 2.25 years. All of us on the same page? Then I need discounted payback period, for which I will look at the present value of the cash flows. Where is my answer? Again, between 2 and 3 only. Again, between 2 and 3. Yes, 2 plus something. 2 plus something. And how much is that something? That is going to be 10,000 minus 3636 recovered in the first year, 4132 in the second year. And I would recover this from 3005. How much is that? It has to be definitely something greater than 2.25, and that is 2.74 years. If management has a benchmark for 2.5 years, what would you do with the project? Management has a benchmark for 2.5 years. What would you do with the project? Ignore. What would you do if the management is looking for projects only with 2.5 years? Reject, right? Done. Calculate NPV. Quickly calculate NPV. Profitability index. Good. $773. What would you do with the project? NPV. Rupees 773. Perfect. What else we are left with? We are left with the profitability index. So what will you do with the profitability index, please? Profitability index, you have all the data points. Only thing is you will get the ratio. $0.92, little doubtful because I'm able to accept the project. 1.077, right? So this is one-stop solution. Now can we go to the, okay, this is interesting. The next one, I want to do that also with you. Before that, can I go to the application of this in a form of caselet? So now the path has been shared. Can you look at the caselet that has been shared in that module, live session 3? Can you look at the case study that has been shared so that we can look at one practical application? Look at this file case study in live session 3. Have a look. Let me know once you're ready, please. So I can then application, we can go ahead. Ready? Okay. Let's look at this case. Very interesting. Okay. You're going to give your comments on the same. So, Aryan Limited is one of the renowned publishers of school books, which is well known for its good quality books. The sales force of the organization is highly dedicated and is thus able to bring good projects for the organization. Although the organization takes only one project at a time due to lack of resources, it completes the project with full enthusiasm along with proper checks on quality. Now, can you tell me that when it says that it can take up only one project at a time, so will it select mutually exclusive project? Does it mean that it is going to select only mutually exclusive project? Does that mean? Yes, so it can select only one of the projects at one particular time, so mutually exclusive project that it is talking about. Like always, a sales team of the company has come up with two new projects and the organization needs to select one of them because it's mutually exclusive. For this purpose, both the projects are analyzed qualitatively and quantitatively by the management of the organization. So qualitative, as I was talking about, when you have any project and you're looking at qualitatively the analysis of that project, so you will look at, okay, if I take up this project, how will it improve my brand image, the value of my company? How will I get my good opportunities in the near future, and so on? That is the qualitative way. You're not looking at profits, you're not looking at numbers, and so on. So, but when you look at qualitative analysis, you also want to know that whether the project is equally profitable also for you or not. So once the qualitative analysis is done, we as corporate finance manager look at the quantitative analysis of the project. Then during the quantitative analysis, the finance manager found that the weighted average cost of capital. What is the meaning of weighted average cost of capital? Let's first understand that. What is the meaning of weighted average cost of capital? Cost of debt plus, so can I say the rate that or the cost at which the company borrows money from the market? Any project that you would make the investment, do you want that the return from that investment should be greater than cost of capital, the bare minimum? The bare minimum I would be looking at should be that the return from the project should be greater than my cost of capital. Yes. Yeah. So you have two projects. Now, if you are the finance manager, the first project would cost you $7 million and it will generate $3 million, not from the first and the second year, but from third year to the seventh year. Okay. And there's another project which will cost $2.5 million and you will get $2 million every year for the next 3 years. Now, can you see here? Here my outflow is 7, here my outflow is 2.5. So here, would you prefer rupee or would you prefer, rupee or dollar, or would you prefer ratio here? My outflow is not the same. Would you prefer dollars or would you prefer the ratio? The outflow is not the same in both the cases, ratio. Can you help me to know whether if you are the corporate finance manager, would you want to go for project A, project 1 or project 2? I'll wait for 2 minutes and then I will intervene to help you. Make sense? Okay, I need the quantitative analysis. Why? Why? Okay, 1.7. No, no, not correct. Okay, I'll just give you a hint here. In the first project, I'm not earning anything on the first and the second year. So your cash flow is not starting only from third or year onwards. It's starting only from third year onwards. Little tricky here. So I'll just explain the question to you. When I'm making investment, I'm not earning anything from that in the first 2 years. I'm earning it only from the third year. So 0 year, I make the investment. I don't earn anything on the first, second year. I start earning only from third year to 7th year. So third year, I will earn. Fourth year, I will earn something from the project, that is 3 million. I will earn it on the 5th year, 6th year, and 7th year. First and second, I'm not earning it. So when you find out the present value of the cash flows, it will be for the third year, fourth year, 5th year, 6th year, and 7th year. And in case you're using annuity, then if you do it for all 7 years, then subtract the present value for the first and the second year. Is the logic clear to the class? I'm not earning anything on the first and the second year. I'm earning nothing. I am getting nothing out of that. So my present value would be done for third year, fourth, fifth, sixth, and 7th year. In case you're using annuity, then let me tell you, you're doing it for all the 7 years, then subtract the present value of the first and the second year. Is the logic clear? If not, I would explain again. Yes, team, is the logic clear to all of us? You're not considering first and second year, Aditya. Third year onwards, you're considering. Yes, please now tell me the fresh answer. Tell me fresh PI for the first one. It's very interesting. 1.47 according to Ganesh, which is absolutely right. Others, I'll wait for a minute or two. You're not earning anything in the first and the second year. Ganesh says 1.47. Vinay, 1.93 for which one? First one, no. You're having the cash flows on the third year, fourth year, fifth year, sixth year, and 7th year. That's it. Vinay, check. $1.47 is absolutely right. Vinay, you need, should I solve? Sure, I'll do that. I'll do that. I'll do that. So here I'm saying my present value of cash inflows would be equal to 3 million divided by 1.08 raised to 3, because I'm not receiving anything for the first and the second year. And I would do this from third year till the 7th year. Is that clear now? So this, I will do it from the third year. I'll do it for the fourth year. I will do it for the 5th year, or use the annuity formula. That is also okay. I'll do it for the 6th year and the 7th year. Is that logic clear now? Because I'm not earning anything for the first and the second year. So I'm going to earn it only from the third year onwards. So third year, fourth year, 5th year, 6th year also I'm earning it, and plus I'm earning it for the 7th year. Yes, now tell me what is the answer. This is my present value of the cash inflows. And this amounts to how much? Vinay and Jyoti, is the logic clear? And if you're using annuity, then if you're doing it for all the 7 years, then subtract the present value for the first and the second year. The answer would be the same. Is this logic clear? Yes. So how much is my PI now? How much is my PI? Okay. 3.27 for which one? I think mistake you're doing somewhere, Vinay. I would do 3 divided by 1.08 raised to 3. Just do the put the brackets and then do it, else you will get number 2. Okay, tell me the final. Tell me the final. You tell me the final answer. What I have got is 10.27. I have got it as 10.27 as the final. So my PI would turn out to be 10.27 divided by 7, which we have got most of us as 1.47. See if this same answer you're getting. Just check if it's the same answer. If you're anywhere you do it, but the answer cannot be different. 1.47, if you approximate, it's 1.5. That's okay, don't worry. That's okay, Eunice. Second one, tell me what's happening. Every year, this is easier one. First, second, and the third year, I'm getting 2 million each. What is going to be my profitability index here? What is going to be my profitability index here? $2.06. Do we all agree with him? Now, keeping in mind, if you are the finance manager of the company, 2.06. Perfect, perfect. So if you are the finance manager, here, if I look at qualitative aspects, could be one of the ways of looking at the project. But when you look at quantitative data, I would definitely want to go for project 2, where my profitability index is greater as compared to the first project. So I will go for project number 2. This is how we look at it. This is the application of the real application that you get to see in the companies. Fine? Any questions here? Anyone? Are we good? So one request, Pranjay has shared a link for the feedback. So that would be great if you can spend a minute and fill that. That it helps us to collate the data. I'll wait for a minute and then can we go ahead with the fresh discussion? There's one more important, very nice case study that I have planned for the day. This one, but I'll wait for a minute before we get into this. Let me know once you're ready, please. Done? Can we move to this interesting one? You have IA3 at 9:30. Why? Okay, is it today? Achha, I thought it happened in the evening. Pranjit, do we have? It's in the. Oh, so you want me to revise anything before you go for your IA? Then I wouldn't start this. I wouldn't start this. Today is the third IA. Okay, so what is the syllabus for the third IA? Let me just quickly help you with the same. So you have IRR, PI, and project comparison. Okay, so we're discussing that only. Okay, so any questions that you have before so that I can help you in that? So should I go for this particular caselet or not? Or you want to go through something, and if you have a query, you ask me. I shouldn't start with this caselet now. Should we do this tomorrow? That is why the it was something called the attendance. I saw it's dipping. Is it because that people are now worried about the IA? Okay, no problem. I'll go through this tomorrow. But sure. Anything that you want me to discuss regarding PI or IRR or project comparison? So just remember that each of the methods that we have seen, you always need to know that which project are you going to select and why. Whichever method you are using, which one would you use? Which method are you going to use? And why would you use that method? And what is the selection and rejection criteria for each of the method is again going to be something very, very important. So I'm waiting. If you have any questions, I can answer that so that it helps you. No questions? You want me to wind up early? Or do you want me to be there? That would be part of your IA 4 and 5. Yes, I'm going to cover that tomorrow. So that would become part of basically IA 5, Ankit. So where we do the project comparison and everything. All right, then Let's wind up here. All the best for your IA. Let's connect again tomorrow evening. So we do with the estimation of cash flows and try to understand how the project selections are done in the advanced evaluation methods. So good night and take care.